These rising tensions in the war with Iran are now hitting Americans where it hurts, and that's their wallets. Markets are going to be opening up soon, and traders are keeping an eye on those oil prices, all linked back to the Strait of Hormuz, and also some new signs that show food costs could go up next. NewsNation's Alicia Nieves is inside the New York Stock Exchange this morning. So this fear about oil putting the squeeze on pretty much or potentially everything right now.
Yeah, good morning, Marni. That's certainly what we're seeing, now 2 weeks into this conflict and working on week 3. Listen, markets where we're at right now, looking to actually open up to the upside this morning, which has been something I've been kind of scratching my head on for the last, 2 hours or so, that we've seen markets move from negative territory in the pre-market to now positive territory. The only thing I can think of is that there's a buy the dip mentality is what we're seeing here, because it's been a substantial dip over the last week, right? Yesterday, for example, markets closed across the board in negative territory. The Dow, in fact, closing under 47,000 for the first time in 2006, as we saw oil prices continue to climb, spiking some 10% alone yesterday. Crude oil, for the first time since 2022, actually closing at $100 a barrel or just above that. This is something that, even despite some of the optimism that's being priced into markets this morning, that it's certainly weighing on markets, because as you pointed out a moment ago, it is affecting almost everything right now. Certainly at the pump, what we're seeing there, gas prices continue to rise. As Connell was mentioning a moment ago, Iran has no indication and has not indicated that it's going to let any traffic go through the Strait of Hormuz, any meaningful traffic at least, go through the Strait of Hormuz, as it's using that as a tool to pressure the energy. But as you point out, it goes beyond the prices at the pump, that right now, $3.63 is the national average, up around 4 cents just overnight. We are seeing new concern now this morning about the global food supply. 1/3 of the world's seaborne fertilizer moves through the Strait of Hormuz, and that is being disrupted, pushing fertilizer prices up roughly 30% in just 2 weeks. And gotta say, if it costs more to grow food, there's two problems here. Potentially, farmers this year have to, make the calculation: can they afford to plant the crops for next season? And two, certainly the calculation of it's going to cost the consumer more. It's going to have to be passed down to the consumer. It's another inflationary pressure we are now continuing to follow going into week 3 of this conflict, Marni. It's something that's going to have to, weigh on markets or be factored into markets today, and certainly something that's going to be factored into American households.
I spoke with farmers this week who said they're essentially putting their crops on a diet with the fertilizer concerns and a shortage. We also just, Alicia, got an inflation report, a new inflation report. What did that show about the likelihood, which we always ask, of a rate cut?
Yeah, PCE data just came out this morning. It's the Fed's favorite gauge for inflation, and a lot of people, paying close attention to it because they are concerned that, maybe next week we get a rate cut that could alleviate the pressure on the consumer. This data shows it's very unlikely that we're going to get a rate cut for a couple of reasons here. For one, we still saw prices go up 0.3% month over month, 2.8% year over year, and that's on headline. If you look at core, it actually went up around 3.1%. A few things factoring here. First, we're still seeing inflationary pressures. Second, this is kind of old data. It's actually a delayed January's report. And then third, the inflationary pressures that I mentioned a moment ago that are in real time happening right now has to be a concern on the Fed and the FOMC when they meet next week. Cutting rates sounds good in terms of potential relief, but lower rates are actually inflationary. If borrowing is less, people can spend more, and it leaves no room for prices to actually come back right down. What I will say is, in terms of relief for the American consumer, I'll reiterate this. We know that the U.S. is trying to ease pressures by releasing strategic oil reserves. It's going to take some time for that to work into the actual oil supply. We're told by analysts in the oil sector about 4 months. So that may be a potential relief for the average American consumer that they can look out for. But that relief is going to take longer than the pricing pressures that we're seeing, be factored in as this conflict continues, Marni.
Thank you for watching. Subscribe below and download our NewsNation app right now on your phone, and you will get fact-based, unbiased news for all Americans.